Also, another classification of costs, we can look at classification of costs based on controllability, ability of the management to control the cost. And under this category, we shall be classifying costs based, looking at it on the angle of controllable cost and non-controllable costs. Now, controllable costs are costs which can be influenced by its budget holder. That is, the management has a degree of influence on it. The difference between the term is very, very important, because the purpose of cost accounting, cost control, and responsibility accounting. Okay, so a controllable cost can be controlled by a person at a given organizational level. So controllable costs are not totally controllable. Must take note of that. Some costs are partly controllable by one person and partly by another person. So maintenance costs can be controlled by both the production and maintenance the maintaining department. Okay, maintenance department rather. So maintenance costs can be controlled by both the production and maintenance department, as maintenance manager. The term controllable costs is often used to mean variable costs. So when you're talking about controllable costs, most time we look at what? We'll look at variable costs, because variable cost is based on your decision. If you decide to increase your production capacity, your variable costs will also increase. So the management has influence on variable costs. So most often controllable cost is often used to mean variable costs, and non-controllable costs sometimes is also referred to as a fixed cost. But however, the following fallacies about the controllable costs we are given. One of the fallacy is that fallacy of controllable costs. One of them is that all variable costs are controllable. All variable costs are what? They are controllable costs, and all fixed costs are non-controllable. That's one of the fallacy of controllable and non-controllable costs. And secondly, there's a fallacy that also said that all direct costs are controllable. Management has a degree of influence, and indirect costs, this is a fallacy, are not controllable. That is, they are what? They are non-controllable costs. So there's also another fallacy. Another fallacy states that what? All long-term costs are controllable. All long-term costs are controllable, and sometimes the time factor and the decision-making authority can make a cost controllable. So all long-term costs are controllable. If the time period is long enough, all costs can be controlled. So because long term is very long, is a period of production that is very long. So all long term costs are controllable. So it's a fallacy. So period. So all costs in the long run are said to be controllable. And if you look at the economics angle, they tell you that in a long run production period, all costs are variable costs, and the fallacy of all variable costs are controllable makes all costs in the long run to be a controllable cost. So all costs can be controlled. All costs in the long run can be controlled. Okay, so take note of that. But all costs can be controlled by one or another person. The authority and responsibility of cost control is delegated to a different level, though the managing director is responsible for all the costs. You must take note of that. Another form of classification of cost here is a classification based on analytical and decision making purpose. You can classify costs based on analytical and decision making purpose. Here we shall be looking at what we mean by opportunity cost. What is opportunity cost? Opportunity cost is the cost of selecting one course of action and losing of the other opportunities to carry out the cost of what, and losing what of other opportunities to carry out that cost of what action. That is what we mean by opportunity costs. So take note of that. It is the amount that can be what received if the asset is utilized in its next best alternative. And sometimes opportunity cost, I always say, it is what the benefit forgone from the alternative not choosing. It is also termed the opportunity cost. So for analytical decision purpose, we must consider our opportunity cost. We also have what we call the sunk cost. The sunk cost. The sunk cost. So though opportunity cost has also been defined as the best lost by rejecting the best competing alternative to the one choosing. So many definitions. The best lost is usually the next earning or profit that might have been earned from the rejected alternative. You must also take note of that definition. So the sunk cost. A sunk cost is one that has already been incurred and cannot be avoided by the decision taken in the future. So as it is referred to past cost, it is called unavoidable cost. So another sunk cost is unavoidable cost, and that is how sunk cost is being viewed. Okay, so this cost is not useful for decision making, or you have to know past costs are not considered when you are making when you are taking decision. A sunk cost as an expenditure for equipment or productive resources which has no economic relevance to the present decision process. So that's why it is not useful for economic decision purposes. So the CIMA defines it as the past costs not taken into account in decision making. That's what CIMA defined sunk cost as. They say it is what is the past cost not taken into account in decision making. So we also have what we call the differential cost. Differential cost has been defined as the difference in total cost between alternatives calculated to assist decision making. Differential cost is the increase or decrease in the total cost resulting out of the following. For one, it is what producing and distributing a few more or few less of a product. What is the effect of that decision? That is what we are talking about when we are looking at differential costs. Okay. Then secondly, a change in the method of production and distribution. What effect will it have? What has changed? So a change in the method of distribution is distribution of or method of production. So the difference when the previous method was being applied, the difference when the present was being is now being put in place. So we want to look at it. Then the selection of an additional sales channel is also part of differential cost. Also we look at we also look at another form of cost which we tag. So differential cost between any two levels of production is the difference between the marginal cost at these two levels and the increase or decrease in the fixed cost. So if any, that is attributable fixed cost. So these costs are usually specific purpose costs, as they are what determined for a particular purpose and under a specific circumstance or condition. So another cost under analytical purpose is what we call incremental cost. Incremental cost, and incremental cost measures the addition in units for an additional in output. Addition in unit for additional in output. That is what we mean by incremental costs. So this is also another form of differential cost. So this cost need not to be the same as at all levels of production. It is usually expressed as a cost per unit, whereas the differential cost is measured in total. So this incremental cost is cost per unit, but differential cost is measured in total. So that is the little bottom or little line of difference between incremental and differential cost. Differential cost is measured the difference in total, but when we are using incremental cost, we are looking at the difference in units in output, in an additional output. So the cost need not to be the same at all level of production. It is usually expressed as a cost per unit, whereas the differential cost is measured in total. That is just all we need to know about differential cost. So differential cost is useful in planning. It's very good. It's a very cost you need to consider in decision making, and it helps to choose the best alternative. It helps management to know the additional profit that would have been earned if idle capacity is used or utilized, or even when additional investments are made. That is the essence of differential cost. We also have what we call joint costs. Under this joint cost, remember we are still under cost classification for analytical and decision making purpose. So also part of it is what we call joint costs. The joint cost, the process of a single raw material resulting to two or more different products simultaneously is what we call a joint product. So as a result of that, a joint cost is being incurred. So the joint products are not identifiable as different type of product until a certain stage of production known as split off point. We'll be looking at that is reached. So joint costs are the cost incurred up to the point of separation. That's what we call the joint cost. So one product may be of more importance and the other of minor importance, which are called byproducts. So the one of minor importance are called byproducts, but the cost that have been incurred together before the split off point is what we call a joint cost. Joint costs relate to a situation in which the factors of production by their basic nature result into two or more products. So the jointness result from there being more than one product, and these multiple products are the result of the method of production or the nature of raw materials, and not of a decision by management to produce that. For your refining of crude oil, you can see before you get your petrol, what you call petrol, the HPMS, other things must have come up, the chemical they use for soap making and the rest. So that is what we call a joint cost. So a joint cost relates to two or more products produced from a common production process or element material, labor, overhead, or any combination thereof. So that is what we call a joint cost. So joint cost can be apportioned to different products only by adopting a suitable basis of apportionment. So when we come to the joint and byproduct, we will look at how we allocate that. So the next also there's what we call a common cost. Okay, common costs are those costs which are incurred for more than one product. They are incurred for more than one product, job, territory, or any other specific costs object or costing object. they are not easily what related with individual product, and hence are generally what apportioned. So they are generally what apportioned. You can say what? You can say that common cost, they are the cost of service employed in what? In creation of two or more output, which is not what allocatable to what those output on a clearly justified what basis. So it should be kept in mind that management decision influence the what? The incurrence of what? Of a common cost. For instance, rent of a factory is a common cost to what? To all departments located in that factory. Like some furniture making companies, the office, the showroom is there, and the factory is there. So the rent of that place is what we call a common cost. So we also have what we call inputted cost. So some costs are not incurred and are useful while taking decision pertaining to a particular situation. These costs are known as inputted or notional cost, and they do not enter into traditional accounting system. So we don't take record of them. For example of that kind of cost is interest on internal generated fund. That is like your retained profits. Interest on internal generated fund is like salary of the owners of the owners of the business. Like for instance, a proprietor, a partnership, those salary, notional rent. The owner of the business is using the house, his own personal house, so to run the business. So all those things are what we call inputted costs. They are what called inputted costs. Okay. Now we also have what we call the uniform cost. Now they are not distinct costs as such, so there is not a new cost per se. So uniform costing signifies common costing principle and produces procedure adopted by number of firms. So they are useful in inter-firm comparison. That is, a particular industry may choose a particular form of may choose a uniform way of reporting. So that in such a way we call that uniform costing. So that is what we mean by uniform costing. It's not just a new method, it's not distinct cost. So we also have what we call marginal costing. And I hope you know what we mean by marginal costing, which we'll be considering as a topic very soon. Marginal costing is also one of the cost for decision making purpose. It is the aggregate of variable costs. When we talk about marginal cost in cost accounting, we are looking at variable costs. It does not mean what the economists mean, or what the economist says about marginal cost. To an economist, it is the additional cost incurred for additional units produced. But in cost accounting, when we talk about marginal costing, we are talking about variable costing. So marginal cost is the aggregate of variable costs. That is the prime cost plus variable overheads. The prime cost plus variable overhead. So costs are classified as in marginal costing techniques. When we come there, we will be classifying cost as fixed and variable costs. Those are the two ways we classify costs. So we will be valuing the inventory based on what we call variable cost or marginal costs. Okay. So we also have what we call replacement cost. Now this is the cost of replacing an asset at a current market value. So when the cost of replacing an asset is considered, it means the cost of purchasing the asset at the current market price. It is important and not the cost. It is important and not the cost at which it was purchased, but the costs of replacing it in the current market price. So we'll call it that we call that replacement cost. So that is what we mean by replacement cost. We also have what we call out of pocket costs. Out of pocket costs. It involves payments to outsiders. For instance, that is, it gives rise to cash expenditure as opposed to such cost as depreciation. Now, depreciation is not a cash outflow. So out of pocket costs are those costs that will necessitate cash to flow out of the organization to the third party. So that's why we call them out of pocket costs. So depreciation which does not involve what any cash expenditure. So such costs are relevant for price fixation during the recession, or when the market when make or buy decision is to be what to be made. They are very, very what important. So we call them out of pocket cost. Depreciation does not constitute it because there is no cash outflow for depreciation. So lastly, we'll look at what other costs, other way. We have what we call the conventional cost. Conversion cost rather. Here conversion cost is the cost of a finished what product or work in progress. So it comprises direct labor and manufacturing overhead. So what it takes to turn a product from its raw material to its finished product is what we call conversion cost. So it is very, very important. So your conversion cost is very, very important. So that's what we call conversion cost. Whatever you incur to transform a raw material into finished goods is what we call conversion cost. Okay, and we say another way is what it is production cost less the cost of raw material, but including the gains and losses in weight or volume of direct material arising due to production. So that's another way we can get your conversion cost. That is the production cost minus cost of your raw material is your conversion cost. Okay, another way is another form of cost is what we call normal cost. Normal cost. Now this is the cost which is normally incurred at a given level of output. Is the cost normally incurred at a given level of output in a condition in which that level of output is achieved, is what we call a normal cost. Then we also have what we call traceable cost. So it is the cost which can be easily associated with a product. Remember what we call cost classification based with association with a product or department. We call it traceable cost. Remember we also have what we call avoidable cost. That is cost that you can refuse to incur based on your decision. And if you remember, we said all variable costs are controllable, and because they are controllable, they are also avoidable. So avoidable costs are those costs which under the present condition need not to have been incurred. The spoilage, for instance, spoilage in excess of normal limit, unavoidable cost variances which could have been controlled. We call them avoidable cost. Okay. So we have unavoidable cost, which is the other counterpart of cost. Unavoidable cost. Unavoidable costs are those costs which under the present condition must be incurred. They must be incurred. We call them unavoidable cost. Then we have the total cost. We have total cost. Of course, you know what total cost is: summation of the variable and the fixed cost. So total cost, this is the sum of all costs associated to a product unit or process or a department or batch or even the entire consign. So it may also mean the sum total of material, labor, overhead. The term total cost, however, is not precise. It needs to be made precise by using the term that indicates the element of cost included. So that is what we mean by a total cost, and for simple purpose, TC equals to FC, that is TFC, total fixed cost, plus TVC, total variable cost. We also have what we call the value added. We have value added. Strictly, it is not costs. It means the selling price of the product, service less the cost of material used. That's what I mean by what we call value added. So please take note of that. Okay. So a cost which does not involve any cash outflow is called dash. A cost which does not involve any cash outflow is called dash. It is called a notional cost or inputted cost. So a notional cost or imputed cost is a cost that do not involve any cash outflow. So please take note of that. Thank you.